Assalamualaikum. So we are going to talk about the news titled. Okay, so the news is all about the Central Bank of Korea, which is the BOK, announcing the temporary measure to increase the supply of US dollar in the domestic foreign exchange market. So this measure is to stabilize the Korean won, which has been under pressure and weakens against the US dollar. So to do this, the BOK will inject more US dollar in the domestic foreign exchange market, which is to calm the market and reduce the excessive volatility. Okay, so what actually happened to Korean won? So Korean won has been depreciated about more than 8% against the US dollar. So why it is happened? Because the investor of Korea invest more on the foreign companies instead of local, which can increase the demand of US dollar. Okay, so when the demand of US dollar increase, it might decrease the supply, and automatically the won value will be fall and the USD will be more expensive. Okay, this will negatively affect South Korea in several ways. First, it might increase the cost of import and it will lead to a higher inflation in the Korean market. Second, the company with US dollar denominated debt might face a higher repayment cost. Okay, so the third one is the weakened value of Korean currency might reduce the investor confidence and increase the financial instability in the market. Therefore, by increasing the supply of US dollar, the Bank of Korea aims to stabilize and protect the stability of the financial and economics of Korea.
The first policy is, yes, it is true. For 6 months, starting on January 2026, the Bank of South Korea has decided to compensate an interest payment on any excessive foreign currency reserve held by the financial institutions. To further explain, the financial institutions usually need to hold a minimum required amount of this foreign currency reserve, and usually they hold more than the minimum required amount and invest that excess amount to somewhere else, such as overseas, in order for them to get much higher return from the interest payment. But however, due to this temporary policy that has been introduced by the Bank of South Korea, the bank now has decided to pay the interest payment for any excess amount in the foreign currency reserve held by these financial institutions, which later makes it more attractive for them to deposit that excess amount in South Korea rather than abroad. As a result, this will lead to more financial institutions to deposit their excess foreign currency reserve with the Bank of Korea, as it is more well regulated, safe, and also provides a higher return. This actually results to an increases in the supply of dollars in the South Korean economy, and simultaneously increases the demand for won due to a much higher interest payment needs to be paid to these financial institutions. As a conclusion, this is a market-friendly policy that has been introduced by the Bank of Korea, as it encourages dollars liquidity, increase the inflows of foreign currency assets of USD into the Korean economy, and last but not least, strengthen the value of won. Thank you.
So, the next policy that the Central Bank of Korea has imposed in order to cater this problem is by extending the swap line for the National Pension Service, or NPS. Usually, the National Pension Service invests a lot overseas, and they need a lot of US dollars to invest abroad. So, usually, they will purchase US dollar from the foreign exchange market, and this practice will eventually increase the USD demand and weakens the Korean won currency. So, with the swap line, the Central Bank of Korea will directly provide the US dollars to the National Pension Service. So, they don't have to purchase any dollars from the foreign market. This practice will help to reduce the demand for US dollars and maintain the stability of won currency. Furthermore, the third policy is the loosening of currency forward limits for the banks. Forward contracts are agreements for exchange of currency in the future. So, by loosening these limits, banks can do more of these transactions, especially with the exporters who will receive US dollars in the future. This allows the banks to supply more US dollars into the market now, as well as increasing the supply of US dollars into the foreign exchange market. So, overall, the second policy reduces the demand for US dollars, while the third policy increase the supply of US dollars. So both of these policies will help to stabilize the one currency and reduce the risk for the sharp depreciation of one currency.
Okay, moving on to the other key measures taken by the Bank of Korea, which is the waiver of FX stability deposit requirement. First, let me explain what is the deposit requirement being stated in the article. Normally, when a financial institution in South Korea borrow money in foreign currencies, such as the US dollars, they are required to place a deposit with the government. This deposit acts as a safeguard to reduce excessive foreign currency borrowings and to protect the financial stability. However, during the period of stress in the foreign exchange market, this requirement can actually reduce the availability of dollars in the domestic market. To address this issue, the Bank of Korea temporarily exempted financial institutions from making this FX stability deposit when holding foreign exchange debt. So, what was the purpose of this action? Okay, by waiving the deposit requirement, banks were able to use more of their foreign currency funds directly instead of locking them up for deposit purposes. This helped to increase what we call the dollar liquidity in the local FX market and ease the pressure on the Korean won, which had been weakening. In simple terms, this policy made it cheaper and easier for banks to hold and also circulate the US dollars within South Korea. As a result, it reduced what we call the panic demand for the foreign currency and helped what we call stabilize exchange rate movement. Overall, this measure shows how the Bank of Korea used what we call the regulatory flexibility rather than interest rate changes to support the FX market stability during a volatile period. Thank you very much.
In conclusion, South Korea's recent measures show just how important central banks are in keeping currency markets stabilized. With the weakening of won, the Bank of Korea has stepped in with some temporary measurements, like encourage foreign currency deposits and easing the deposit rules. This helps to manage currency stabilize. But this isn't just about exchange rate. This step addresses the bigger concerns like rising inflation and large overseas investment by pension funds, companies and retail investors. The government and regulators are working together to address this issue, using swap, monitoring financial firms and guiding companies to prevent speculating and keep the market steady. Looking ahead to 2026, what do you think will happen to won? Will it strengthen or weaken? Comment below.